Hey Trader Steven here. It is Wednesday, March 27th. I'm going to do this a day early. I normally do my webinar on Thursday, but it's been a couple weeks. Last week I was on vacation, so I figured I'd go ahead and get this out there for you guys because there's just kind of some wishy-washy going on in the market now. So we're going to talk a lot about, bonds and yields are looking really interesting. Gold and oil is looking interesting. So we're going to look at the index, and then we're going to look at the breadth, and then we're going to look at sectors and industries, and we really have a lot to cover today, as I usually do. So let me start with the Nasdaq. Let's look at the overall market. So a couple weeks ago, I was really talking about these mega trends, right? They just kind of happen where I typically will call the 20-day EMA the rally line. And usually what's going to happen is the market will find support when you're in a rally, it'll find support a couple times at that 20-day moving average. A lot of times the third time it'll break, which it did, but it came right back. Now that's a lot of strength right there. So, and when I saw this happened on a Friday and it reversed. And then I saw this big candle on Monday. I immediately changed my tune from bullish to bearish because that's a lot of strength. So, and it just kind of reminded me of sometimes, like, when you're in a pullback, it can seem ugly. It really can. And then all of a sudden, just the market finds support. So a lot of times, it won't find support at the 20. It'll come down to the 50 and then just continue to rally. Whereas if you're using just the 20-day moving average, you'll get stopped out a lot and have to get back in, back it up to the 50, and then you'll be a lot better. So you had a really strong trend. You have a really strong trend here, and the fact that it broke and then came back is showing some strength. Now, we're kind of getting this today. I should have a question mark right here. Like, this worked. It completely just kind of picked off all these highs, just kind of ran the stops a little bit. And now we're in another pullback. So the market has came a lot off the bottom today, but is it going to continue to rally off the bottom? We don't really know at this point in time, but I always say, like, if we go back to the market, like, let's just look at the Nasdaq. Started kind of around break even, and then just sold off, and then comes back. So what I would focus on, and what I typically focus on, is just try to make trading decisions towards the end of the day, because you might have it start strong, finish weak. You might have it finish weak, or start weak and finish strong. But I try to wait till the latter part of the day to see if the market's going to come in and find support, or to see if it's going to roll over. So it's just kind of a good rule of thumb. I try to make most of my trading decisions. Now, what I'm looking at right now is you have this 50 coming up. It's about to cross on the 200-day moving average. So you're pretty close, a couple points away to getting a golden cross. Which would really favor a better environment. Now, we've had a really strong, just straight off the bottom rally, but I mean, this still could be a bear market rally. You don't know because we haven't taken out the highs yet. So we don't know right now if the market is going to find support or not. It seems reasonable that, in this zone would be a support area, and it could kind of trend sideways. But if it breaks, you need to have a game plan in place. It's just like, I don't really need to, when the market starts to sell off, I don't really need to just go start selling off my stocks. I have a rule for each individual position I'm in, right? It's comforting. Like, if the market comes down here, it ends up running out my stops. So what? So be it, but I have rules, and I have these rules in place to keep me in for when this happens, right? This ran a couple of my stocks, but it kept me in one or two. So it's going to keep you in the strongest stocks. And so just kind of keep that in mind. Whatever happens, whether the market, even though the market is kind of looking a little tired, like it needs to digest some gains, but have a game plan for whatever happens, whether we take another leg down or we find support. But I caution you to, suffer from, hey, we're going to take this second leg down. I think it pays over time, and this is something that's cost me money over the years. It definitely pays to be a bull. Like, you want to have a bullish bias, especially when you're in an uptrend. If you're always trying to say the market's going to go down, the market's going to go down a lot, eventually, yes, you will be right, but it's going to cost you some up move, right? And you don't want to do that. And just one thing that I found is, and even over the years, is a lot of times this will happen. I'll say, oh, the market's going to roll over, and it just comes right back. Most pullbacks are just pullbacks, even if they develop into a correction. Like, that's an opportunity, right? This bear market doesn't happen as often as, you know, you might think, especially if we've lived here in 2008, 2001 type of bear market scenarios, but this didn't happen that often. So most of them are pullbacks or they're corrections, right? But you have your rules in place to keep you in the strong stocks. Now, if we go to the weekly chart, let's go to the weekly chart of the NASDAQ. Come on. There we go. You know, it's really interesting. I like looking at weekly charts to kind of get a bigger picture. And this is the 10-week and the 40-week. Same as the 5200-day for the daily chart. The NASDAQ, it really just took a 25% move to the downside. Okay, so that, I mean, bear market, above 20%. You now have the golden cross. It looks like it's happening on the weekly chart. Okay, we don't know if this will hold yet because the market's kind of coming under pressure, but you know, we're still up on the week. But what's interesting to me is you have these just waterfall effects, and a lot of times bear markets are not V-shaped. They might come down and create a handle, they might come down and test, but yeah, I said most of the times. But look at how it just, you know, undercut it, ran this stop. Everybody's scared, and then just right after it just kind of picks these off, then it comes back, and it comes back in a strong way. And growth stocks have been strong on this rally. So I'm not telling you to go out there and buy with abandonment, but I'm saying a lot of times, you know, if it comes down, and let's just say it comes down halfway, I mean, if it didn't undercut this, I mean, it just goes to show it could be more strength coming out of this. So stops are meant to be run a lot of times. It's a magnet. It's going to pick it off. It's going to pick it off. That's why a lot of times I talk about zones, you know, support zones instead of picking a specific price. Now, if we look at the S&P 500, let me move this back. On the daily chart, you can see it doesn't look that much different than the NASDAQ, but it had several spots right here that were at just slightly different price points, but pretty much the same. And it just kind of and then you have this point. And then so you have 4 different points, and then it just kind of runs through it. And then you have this just strong bar right here, and then it got sold off. So again, I'm kind of looking at this area, this 2670, 2760, 2750. We'll see if it breaks, if it finds support down here. Right now, it's finding support around the 20-day, but I'd say if it breaks, you know, this pullback candle, then I would definitely be cautious. Just if it breaks the 50, it's not the end-all be-all, but if it breaks this, I'd definitely let it, you know, it could definitely open the doors up for lower prices. So you just kind of have to be open to anything, but have a game plan for anything. Now let's look. Now if we look at, let's look at this for a second. Now this is the S&P 500 weekly chart going all the way back to 2009. Look at all these corrections. You got 2010, 11, double correction, 2015, early 2016. You had double corrections in 2018, and then you got the big one. Okay. So then you got the bear market, the 20% correction. I just kind of measured this. I could be slightly off on that number. But my point is you have a 9-year trend line, we'll call it 8.5 because this broke last year, that just got flushed out. If this holds, I just think that's more strength for our, you know, you have just these super trends, right? These super rallies that can last, you know, 12 to 20 years. You have these significant long periods where even though you have corrections and you can have bear markets, but if it fails to break down after it shakes everybody out, right? After it fails and it comes back strong, if it comes back strong and above average move, I just think that's more strength to the upside. So again, I just have it's important to have a complete open mind that anything can happen. But, you know, I like the fact that it just, even though I didn't like it in the heat of the battle, but this is, I think it's bullish, the fact that it just came and just undercut everything and then just closed back above this trend line with a lot of strength, right? It failed to continue to break down lower yet. We'll just kind of have to wait and see. It could chop around, be a struggling market. But it's just important to notice that this 9.5, 10-year trend line broke, and then it just immediately snapped back. So it has yet to just continue to grind lower. That would be ugly. So if you can't tell, I'm trying to be bullish, but the small caps, but there's some asterisks, right? There is some things that are looking a little bit more bearish, or at least a little bit more pullback, corrective type activity. So this is the small caps, and you can see small caps, they outperformed for a little bit, but right at the small cap peak, the Russell 2000, they've been underperforming the S&P 500, right? It's not what you want to see. And the small caps have already undercut, this low right here, already undercut it, but reverse. So, you can make the bearish case that it undercut this swing low, all right? Or you can make the bullish case that really it, on this measured move, it's really only touched the 38% fib retracement. You call it a bull flag. So there's a lot of ways you can look at it. I would say that if it continues to undercut this low, then I would definitely say it's going to open the doors. But a lot of times, and I've seen these shakeouts, was it 2000 where it can just kind of come down and just start running a few stops. You think that the sky is going to fall, it's going to come all the way down here, and then it just comes down a little bit, reverses just to shake everybody out, scare the bejesus out of everybody, and then come back. Let me go back to show you a, was it the 2010 or 2011 correction? I think it was the 2011. So like, look at right here. So like, you had a rally, and I remember this. This is when the S&P 500 got downgraded, but just some nasty action for 2 straight months. Finally comes out, then it comes down, shakes everybody out. Everybody think it's going to come down here, undercut this, and then it comes back. And it's just one last shakeout. Like, oh my gosh, it's coming again. And then it just continues on. So you have to almost look at the market and say, how is it going to shake me out, right? And how is it going to get me, right? Because the market, it just tends to do that, right? And this is just human emotions, right? Fear and greed. That's all this is. My point is that shakeouts are almost always happen. They're common. But if you get shaken out of stocks and then all of a sudden it comes back with strength, don't have, be willing to flip back to bullish again, and don't have this, the market's just going to come back and roll over. Because you can see right here, when this happened, it couldn't clear this. It started to roll over. Everybody thought, oh my gosh, and it came back, and it didn't even undercut this, didn't even come down to this, it just found this footing, came back. This was a major rally headed out of here. So, history, it pays attention to look at a little history. So let's look at treasury yields and let's look at bonds, because it's just really looked interesting. So you have this goes all the way back to 74, but let's just this downtrend for a very long time. It broke out, this 3%, this is the 10-year, it broke out and then just absolutely rolled over. So, I mean, here I'm sitting here drawing inverse head and shoulders, bull flag, breakout of horizontal, breakout of downtrend line. It's a 30-year trend line, and it just peaks its head above and just gets slammed back down. Very interesting. That's just kind of goes to show you. Now, you might think it's coming all the way down here, but again, it could just shake people out a little bit, right? That's why I try not to look at textbook classic breakout patterns anymore, because those classic breakouts, like, it's just going to find a way to rattle you a little bit. But this is interesting, and, if you flip over to the bond side, yields and bonds have an inverse relationship. When bond prices are up, yields are down, and vice versa. So, but how can you play this? A lot of times that when yields go down, they're positively correlated with financials. So the banks, they make money off higher yields. So when the yields are rolling over, financials are going to roll over with it, historically speaking. And we're going to look at that because financials are weak right now. And yields are negatively correlated with utilities. So utilities are very strong right now. We're going to look at that because the yields are rolling over. So there's a negative correlation. They typically move in the opposite direction. Now, if we go over to the TLT, where are you? So this is a 2-year downtrend, and there is a really good book. I think it is John Murphy, Intermarket Analysis. I think that's the book where, he talks about these cycles, and a lot of times, like, bonds will sell off before stocks will. They'll go in a bear market before stocks will, and they'll come out of a bear market before stocks will. Well, it's this kind of played out because you can see the bonds sold off in 2016 and been in a bear market for 2 years, almost 3, 2.5. Well, then it breaks out, right? So then you can see that bonds started coming off from the bottom in November, way before stocks did. Stocks were still selling off. So bonds bottomed first. They sold off first. They bottomed first. And they come out, breakout, definitive breakout. A lot of times, like, I'm more likely to buy this. Like, you want to kind of buy that retest. But you can see the successful test of the zone. And now it's just going higher. So, and I was looking at this because it was very interesting because, yields were looking strong, and then in this area, then all of a sudden bonds started looking strong and yields started to roll over. So it's just interesting to see this intermarket relationship and how you can't always pinpoint on, like, well, if yields are up today, that must mean the banks are up today because they're positively correlated. It's not always every day, but if you step back and you look at a longer term picture, you look at a long term chart, a lot of times you can see it, and you can see it well. So let's look at a little oil. Is that what I wanted to do? Yeah. So this is a really interesting, so this is West Texas. It's just 45% decline, approximately 46. Man, it's snapped back pretty hard. It's a little bit past that 50% retracement zone, but you can see this is such a steep drop. Right now, oil is in an uptrend, though. That's clear as day. And the energy stocks are getting a little strong, so we'll kind of look at that here in a second. At least I think they are. But this is a pretty steep drop. I'm really interested to see how this plays out, and how this plays out relative to the energy stocks, because eventually this is going to have to maybe even create a W, create a handle, create a something. I mean, it's going to have to, if this is the bottom, it's going to have to retrace this move at some point in time. I seriously would be surprised if you get such a, I mean, this is steeper than the NASDAQ. Because, I mean, look how steep the waterfall this was, and it bounced back, but this bounce back is much stronger. So, I mean, if you just look at the chart, it's a slot. I mean, it's commodity. Commodities are just kind of sloppier. It's harder to just kind of, you can catch a trend, but you better have some good profit taking rules because they're just so choppy, right? You catch a trend and it's just chop, chop, chop. We'll look at the breadth here in a second. Let's look at gold because I think gold is looking really interesting right now. Okay, so you have the GLD up here, ETF. Let's look at that first. So it looks like a nice cup with handle to me. Kind of nice harmonic rounded pattern, drifting a little bit. Maybe it consolidates sideways for a little bit. Gold is down a little bit today, but I'd say for the most part, this pattern looks kind of bullish. And I think we could enter a period where gold could outperform for a few years. And I'm showing you that to say, okay, let's look at the daily chart. Then we're going to look at the long-term chart of GDX. And kind of back to my previous point, like, if that waterfall happens, right, and it just runs all the stops, and then it shakes you out. Now, this is a scary shakeout, don't get me wrong, but then it just comes back strong, right? And it really fails to kind of bounce and take that second leg down. That, to me, is strength. So even though you're still in no man's land in GDX, but you had a nice cup with handle, you had a nice breakout, you had a nice test, a nice pop, so you can see that it broke above this, came back and tested this support zone, then it broke through this, came back and tested this support zone, and now it's bouncing off it again. Again, you can tell how choppy gold is. It's not really a pretty looking chart, but the point I'm trying to make is if you get shaken out but it comes back strong, I see more bullish than bearish. And if you look at the relative ratio to miners, this is GDX versus GLD. So when this is trending down, it means miners are underperforming. And when it's trending up, it means they're outperforming. You can see that miners have been outperforming the metal for a while now, which is positive. And now it's peeking its head above this downtrend that goes back 2 years. So this is a 2-year downtrend. Now it's starting to peek its head above. That can be significant if this holds. I would probably wait a couple weeks to call it a definitive breakout, but with this looking good, this looking better. I mean, it didn't make a lower low. It failed to make a lower low. It's looking kind of interesting. Now, if we look at, let me kind of go back and look at maybe a 5-year GDX chart, just to kind of back it up a little bit. Okay, so really ugly, but again, right here, you have just this long-term pattern, right? Just no man's land, going nowhere, and then it just runs all these stops, just scares everybody, think gold's coming down here, and it comes right back. Now I say right back, this is a long-term chart, so this is a couple months, but that to me is showing strength. And I mean, I could draw a downtrend line, we could have broken out of it by now. So it's just really interesting how you have kind of this failed breakdown and it came right back. And this is a long-term chart. So again, so you got to be thinking long-term. It's not meaning I'm saying go out and swing trade this. I'm just saying that if you have a multi-year time horizon, I think the failed breakdown is a bullish place to get on board. But we'll have to see, if the dollar continues to strengthen, then that could change the picture a little bit. But I think sometimes these shakeouts are definitely important to have, an important tool to have in your tool belt to know, like, okay, we've already gotten shaken out once and it came back strong. It already got rid of a lot of weak holders, and that's what you want. You want to come back after it just ran out everybody, scared everybody, even got shorts on board, and now they're all covering. What next? Let's look at breadth. So let's look at the short-term breadth, and then we'll look at the long-term breadth. So this is the percent of stocks in the S&P 500 above the 20 EMA. I mean, you can see right here that it definitely weakened a few days before the market started to pull back. So sometimes breadth is an early warning sign. Now, if I see stocks still acting strong, I follow price and volume, but sometimes this is a nice secondary indicator to pay attention to. But it's interesting. So these are all the sector ETFs, and you can see the XLF financials. Look how weak it is. Right? Remember I talked about the inverse relationship, the positive relationship it has with yield. So you've seen yield sell off, and financials have sold off with it. So that's not really a strong place to be. You want to look for pockets of strength. Technology, XLK, very strong, 75%. You're kind of looking for 70% for a nice uptrend. You have discretionary at 50, industrial at 41, healthcare at 56. Really a mixed bag. So you have, it just kind of more looks like corrective / pullback type activity. Staples, XLP is strengthening, which makes sense. It's strengthening when the market is pulling back a few days. Energy has really been choppy with its breadth, but you can see for the most part it's positive now with 82%. I mean, that's some energy stocks rallying. XLB, the materials is weak. Look at utilities. Remember I talked about an inverse relationship with yields. 100% of the XLU stocks are above their 20-day EMA. That's pretty strong right there. So I'm not going to go out and buy a bunch of utilities, but I'm just an interesting place to look at if you're looking for some trends. So technology looks interesting to me. Energy, utilities are looking pretty strong. Let's go look at kind of a longer term picture. Because sometimes I like longer term pictures. I like, a little bit of lag just to get rid of some whipsaws that happen in the market. You can see right here the breadth has taken a double dip because we had a pullback, we had a rally, but this is interesting. And this is, I think, what I sent my subscribers earlier this week. You have the market, you can see my crosshairs right here. The breadth peaked right here. We go up here, and then we had a pullback, and then the price action broke to new highs, but the breadth did not. So there's a cautionary sign right there, and now we're just kind of slopping around. We don't know where it's going to end, but we'll see how it goes. And then this is the percent of stocks above the 20-day, which we already looked at. So sometimes that would be a negative divergence, right? When the price breaks to new highs, but the breadth does not. It means fewer and fewer stocks are pushing up the market. if I want to look at China, I just kind of want to come back to this China chart. Why am I not seeing it? Maybe it's because I'm not up there. Okay, there we are. So the Shanghai Exchange, you know, it came back, it snapped, you know, really broke, I think, a significant area in the chart, and then it just really kind of snapped back with a lot of strength. Again, like it didn't just completely suck it back down, you know, it broke this level, it came back, it tested this level again, and then it came out. So, you know, it's down a lot today, or was last night, but you might want to be looking at some of these ETFs. But you can see right here, this is the Shanghai Exchange versus the S&P 500 relative ratio chart. So you can see the Shanghai has underperformed the S&P 500 for a very long time, really since early 2015, and then it broke out in February relative to the S&P 500. I mean, that's a 4-year chart. That's a 4-year chart, and it's starting to break out. So that is worth paying attention to in my book. Now, it's looking a little weak, but, you know, this is a long-term chart, so we'll kind of let this play out. But, you know, when you're looking for long-term trends or long-term relative outperformance, when you have something that's underperforming for 4 years and all of a sudden it starts to change directions, it is likely, in my opinion, humble opinion, that it will outperform for the next several years. But we'll really just kind of have to wait and see. Let's kind of finish up with some industry ETFs, and I'll go over to the sector ETFs in a second. You know, I always look every day, what's the strongest, what's the weakest? That's just, you know, price percentage-wise. Home construction is popping today. I am assuming that has to do with yields, and I'm assuming that has to deal with somebody big is reporting solid earnings. So, but I mean, that's, I think, significant because home construction has lagged for so long, and now it's coming back. I mean, it peaked way in early 2018. It never even came back. So it has really fleshed out all the weak holders, and now it's coming back consolidating. It's looking pretty good. You have the Jets. I mean, that's not a good trend, so I'm not going to recommend that. But let's kind of look at the relative strength rating on some of the strongest ETFs. And the software is way up there. You can see that now this is the weekly chart. So let's go to the daily chart. I mean, this has already broken an all-time high versus the overall markets. I've seen a lot of software stocks just show a lot of strength. So, you know, it was down a lot, but it held up relatively well. I mean, it was only down from the just straight calculation 20%, so even slightly less than the NASDAQ during the bear market, and it just came roaring back. So, you know, if the market consolidates, I would continue to look at software stocks as a nice place to be. You have the medical devices also broke to an all-time high when the market has not yet, so that's showing a lot of relative strength. So again, if this consolidates, pullbacks, whatever the market does, I would see if this relative strength line rises, meaning it's down less. Semiconductors getting hit the last several days, but also broke to a all-time high, and anything that did that, it's pretty strong considering the market just hadn't got there yet. So you're looking for that relative strength, like what are the best ideas, you know, and technology and medical devices, even some REITs. I do want to show this, even though I don't think it hasn't broken. It's still under its 2016 high, but again, if you have yields that are getting weak, that could be strong for REITs. Good dividend paying, nice rising relative strength. There's some REITs that are looking, stocks that are looking really interesting. Something to pay attention to. From a relative strength rating, again, at the bottom, and this is a 12-month relative strength rating, you know, financials, that looks nasty. That's just not something I want to touch right now. Like you always want to look at, like, there are better options out there right now than this. Like, it couldn't even break through its 200-day. It just got slammed down. The ETF, the banks, is down 9%. Oil and gas, it is weak, although it's surging off the bottom and looking like it's consolidating. So this is XOP. This is different than the XES, but that consolidation is looking bullish. I think that if it can break out, that's a nice consolidation. I like consolidations that last, a couple weeks, couple months, just digest, get rid of all the impatient people, and then it'll head off. So I would, whichever way this breaks, if this breaks down here, if this breaks out here, I would respect it, and I probably wouldn't buy before a break unless I'm seeing a lot of accumulation step in. But it was down pretty nasty on 3/22, which I think was Friday, with the overall market down 4.5%. Let's look at some individual ETFs on a 3-month relative strength rating. This ARKG on 3 months, this has shown a lot of strength. I can't remember an ETF that invests in companies that are engaged in biotech. I think this is more kind of up-and-coming biotechs. But so let's look at the USO. It's shown a lot of relative strength. And this is out of 250 ETFs. So one of the strongest in the last 3 months. Really surged from 9 to 12. Still got a long ways to go. Renaissance IPO. So the IPO market has been good. You can see that it almost broke to an all-time high, and then it's just trying to back off a little bit. But China right here. This has been a very strong China ETF. Now it looks like it wants to consolidate, but it went from 21 to 29 pretty quickly. That's a very good move. Not quite 50%, maybe 40%, but that's very, very strong. So a lot of times what happens and how you want to play this, I'm going to see if this consolidates, but you get one of the strongest ETFs. A lot of times what you can do is, if it dips below RSI 5 and comes out of it, that's just a great little short-term swing trade opportunity. And then you can see the software that we just looked at, technology, just loaded with technology, more technology, and some China in there. So really, really interesting. Let's just go look at, I'm kind of interested to see where the NASDAQ, it kind of looks like it wants to take another leg down. We'll kind of see where it ends. So I'm not going to have any preconceived notions, but let's just look at the sector summary. The only thing positive today is industrial. And then healthcare, technology, utilities. It's really a mixed bag. A lot of times on a nasty day, which I wouldn't really consider this day nasty yet, but, utilities will be towards the top. Consumer staples will be towards the top, just kind of all over the place. Let's see what it's done the last 1 week. Last 1 week, 3 very defensive, the 3 most defensive sectors: staples, REITs, utilities, all defensive, all dividend payers. Financials is the weakest. Let's see on the last 1 month. REITs and utilities, and the reason that is because yields have just rolled over. So even in the last 1 month, market's been pretty strong in the last 1 month. It's up. We're in an uptrend. Defense has still been leading. So, some people will say, well, Steve, you should look at that and not be trading. I'm like, well, man, I'm looking at some individual growth stocks that are acting just fine. So I'm going to follow the price action of those a little bit, and I will be aware what is leading. But if growth stocks are acting good, I want to be in growth stocks. And, not all of them are going to work, but it's just kind of something good to pay attention to.